start to drive more finance into solutions for the ocean and the climate. Today specifically, we're going to be thinking about solutions that will help us to support locally led managed access areas and reserves, MPAs, and other effective conservation measures. We're also going to have an opportunity to hear about how we can drive capital into this sector by de-risking it with insurance, by looking at debt-to-nature swaps that TNC is doing. And we will be having 2 panels today. But before we start our panel discussions, which I promise will be very lively, we are going to start with 2 keynote speakers. The first one being Brett Jenks, who is the CEO of ORRAA, and he will be talking to you a little bit about how ORRAA has been very active in this space for over a decade, and some of the changes we've seen, and some of the changes we're hoping you will help us to address in the near future. So with that, I will hand the stage over to Brett.
Thank you, Kate, and thanks everybody for coming today. This may not be the lively part, but this is equally important, I'm quite sure. Quick story. Let's talk about Nurlini. Nurlini is a fish trader in Indonesia, in Sampu Island. She's one of 250 million coastal employees of what we might call the coastal water complex of the planet. She works as a fish trader on her island, and she has been struggling for quite a long time. Over the last couple of years, she's been able to move from the informal economy to the formal economy, grow her business by 80%, hire 2 employees, her first 2 ever, and begin to build what she might call wealth for the first time in her life. That's possible because of some technical assistance she has received. But let's just put that in context. That's one of 250 million workers in coastal fisheries, which have been under threat and declining value for 3 generations. Let's talk about what that means and why that's so critical. If you look at the coastal seas, 12 nautical miles off the coast, that place where you sit and you have a pina colada and you look out at the sunset, that is the most critical part of the ocean. It's where 83% of coral reefs are found. It's where arguably some very high, potentially north of 90% of blue carbon is. It's where all the mangroves are. It's where all the seagrass beds are. It's where most marine biodiversity is. And yet, over the past 15 years, it's where about only 10% of global marine philanthropy has ended up. So most important place in the ocean, lowest investment. We'll come back to talk about that. That's really why we're here. And that's how do we crowd in more money to the ocean? And in fact, specifically in ORRAA's case, to these coastal communities and to the coastal waters on which they depend. Here's one solution, very promising, we believe, that we have been developing. In fact, 2,000 communities around the world have already adopted this system. We're not going to give you chapter and verse here today, but just very simply, remember the words managed access and reserves. So if you look at this little model of a coastal community, you have a municipality where local leaders are in charge of their local waters, and they are conferring local rights to local fishers to manage access for the first time. So rather than open access and the tragedy of the commons, we have managed access. Second, we have reserves. These reserves are where fish can finally grow up and get big and old and fat and reproduce so that they swim over their larvae into the local fishing grounds. So this combination creates a sort of annuity or a fish bank, which enables not only sustainable management and conservation, but increased wealth, livelihoods, opportunities, and for someone like Nurlini, climate resilience, climate adaptation. This is going to give people a fighting chance. So that's a solution. Results from 47 pilot sites in Indonesia and the Philippines, we saw on average over 300% increases in fish population in the reserves that were created and protected by local communities. That starts to look like an investable proposition. More importantly, in the fishing areas where they themselves have established their own rules and regulations and enforcement, they are now seeing 100% increases over 5 to 6 years in fish population measured as biomass in those fishing waters. That is manna from heaven if you are a coastal fisher in the global south. Well, before I steal the headline, what have we done with that initial work? We're now in 8 countries, 1,800 communities and growing. We have partnerships with the ministries of fisheries of 8 different nations. We're starting to receive support and expressions of demand from many other countries and many other communities around the world. And so the singular question for the next couple of years is, how are we going to scale this very promising solution? What does that look like? I'm sure that question sounds familiar to anyone who's been involved in conservation of any kind in recent years. This is what it looks like just in Southeast Sulawesi, where you can see a pattern where we've established some managed access and reserve areas in partnership with the Ministry of Marine Affairs and Fisheries and many local communities in Indonesia. Now there's a plan to expand on this work, I would say an aggressive, a very promising plan. But ultimately, there's never going to be enough philanthropy in the world to bring this solution to everybody who needs it. If you think about the fact that of the SDG 14 propositions out there, generally, based on this particular analysis, historically there's been a couple $2 billion a year going into the ocean. We need 15, 16, 17 times that to make sure we have a fighting chance, so that Nurlini and 250 million other people who depend on coastal waters have a chance given what's coming to them. To make sure that 1.5 billion people who get their #1 supply of animal protein every day from these coastal waters and these coastal fishers, some of the most climate vulnerable people on Earth, these are the people who need this kind of support. From the development planners, from the DFIs, from the ministries of finance, in addition to ministries of environment and fisheries. This is a cataclysmic catastrophe coming slowly down the pike if we don't address this, and we're going to need the help of private capital. And so that's what we're going to talk about today. How do we begin to finance a solution that we already know works? We're getting very good as NGOs at crowding in resources, at getting to the sources of the funding. I want us to continue to focus on the uses of that funding. How does the money get to a community? How does it make them more resilient? How can we walk away knowing they are better off and they can take it from here, they can manage this themselves? And so we're going to talk about, in part, the world's first. It's always dangerous to say world's first. It's the world's first that we know about, but I'm pretty sure it's the world's first. Small-scale fisheries impact bond. We try to avoid hyperbole. And we're very excited about it, as you can tell. Kate's going to give you far more of the details, but high level, this is about, another innovative finance structure that we think could be utterly transformative if scaled. We're talking about paying for achieved outcomes. We're talking about a sovereign government being able to pay only when the results are achieved. I would imagine as a minister, that might be something that you'd love to bring to the cabinet secretary or the head of state. This is about formalizing those local businesses. Ultimately, this is about conserving the natural resources on which 1.5 billion of the world's most climate vulnerable people depend every single day, in waters that are heating, in habitats that we are losing, at a community level without which we will never achieve 30 by 30, without these other very effective management regimes. So that's at least what ORRAA, in addition to insurance and a whole bunch of other things, have been focused on. And we hope you'll take note and help us figure out how to scale this kind of solution. And so with that, I'm going to introduce to you Mohammed Youssef. Fortunately, his title's already up there, but I'm going to just say he is the Director of Coastal and Small Islands in the Directorate General of Marine Spatial Planning in the Ministry of Marine Affairs and Fisheries. MMAF has been a tremendous partner for RARE. We work in their service and have for a very long time, and we are very proud to have you here. Please join us on stage. Thanks very much. Do you need this? No. Okay.
No. Thank you, Brad. Good afternoon, distinguished guests, ladies and gentlemen. It's my pleasure to be here on behalf of the Director General of Maritime and Marine Special Management. I'm very honored to address you at this prestigious event on financing ocean climate action and OECM through innovative approaches, hosted by ORRAA and Ocean Resilience Action Alliance. The management of Indonesia's marine and fisheries resources place the environment as the commander, which must be guarded for the future of our next generation, and for Indonesia as the world's maritime center. In the implementation, we at the Ministry of Marine Affairs and Fisheries of Indonesia applies the blue economy policy for a sustainable marine and fisheries management. The policies aims to conserve the seas and its resources, to ensure sustainable fisheries activities, and to ensure sustainable marine environment. Based on today's discussion, let me bring you up and closer to the expansion of marine protected area in Indonesia. Indonesia has set its ambition to expand its marine protected area up to 97.5 million hectares, or 30% of its territorial waters in 2045. I'm sorry, not 2030, but 2045. And until last year, in 2022, the extent of Indonesia's marine protected area was 28.9 million hectares, equivalent to 8.7% of Indonesian total area, sea area. As you can see, there is a gap that needs to be fulfilled. To reach our 30% target, we need to accelerate the implementation of the other effective area-based conservation measure, or OECMs. Along with our effort to adopt OECMs in our national policy and conservation program, we have then identified a strong potential OECM called coastal customary community. Jadi in Indonesia we call coastal customary community because all of Indonesian is indigenous people. These communities have carried out marine conservation practices for generations and have the right to manage their own customary marine area independently. This right to manage the customary marine area is given by the government of Indonesia, and the sea and the area is allocated in the Marine Special Plan. So the area is under managed by the special plan. Since 2016, the government of Indonesia has recognized 26 customary communities. There are around 411,000 hectares of marine area identified as a coastal customary community management area, and around 300,000 hectares of it has been allocated in the Marine Special Plan. Distinguished guests, ladies and gentlemen, in managing their customary waters, the community protect the coastal ecosystem to ensure their biodiversity, abundance, and their fisheries resources. Therefore, we are looking forward to alternative financial solutions to support their effort. To do that, we welcome partners to share their views and ideas on the solution, as well as to synergize. Enforce policy, broaden access to the related information, and implement an incentive mechanism. Ladies and gentlemen, distinguished guests, I'm confident that the discussion that will be unfold here will contribute to a brighter, bluer future for our ocean and for all those who depend on them. Thank you.
Thank you so much to both of our guest speakers today. It was a fabulous introduction to really frame the conversation about how we are trying how we are trying to drive capital into this very important sector. Have the privilege and the honor to be joined by just a wonderful, distinguished panel today of subject matter experts who spend their careers and every single day thinking about how we are going to address this great challenge and really truly protect 30 by 30 by 2030. With that, I would just like to briefly introduce, we have Sarah Conway, and she's from WTW. She leads their ecosystem resilience. Then we have Ariana Steinmetz, and she's the Innovation and Scaling Director at ORRAA, who has been a great partner to us, but also a true partner and champion for the ocean space, and she'll be telling us about some of the work that ORRAA has been doing over the last 5 years. In addition to that, we have Leah Glass. And Leah is a senior associate for Blue Carbon Project Development at Sylvestrum. And Leah has been an instrumental force in really developing some of the policy that is helping us to support nature-based solutions and coastal ecosystem wetlands. I'm sorry to say that one of our guest speakers, Slav, had an emergency today and he's not able to join us. And so with that, I would like to go ahead and start. I think, Ariana, my first question will be towards you. And was really hoping that you could tell us a little bit more about ORRAA and how ORRAA has been a driving force to working to build really just a global ocean financing architecture. And can you share with us a little bit more about this work and how blue bonds fit into this broader archetype that you've been working to build?
Perfect, thank you. So yes, thank you for the introduction, and it's great to see so many partners of ours. So ORRAA is an alliance with more than 80 members currently, bringing together the private sector, public sector, governments from both the Global South and Global North, some of the insurance partners we see here, and banking partners. And so we're bringing that together to really form sort of a common sense of what is needed to build that global financial architecture, as you mentioned. Our mission is to drive at least $500 million into coastal communities and really leverage financing tools, community-led and top-down, to then help 250 million coastal community members worldwide. As you mentioned, we are working across the different areas in global ocean finance and have really tried to bring ocean into the finance discussions, but finance into the ocean discussions. We have seen at the Finance Day earlier this week that more and more discussions on ocean financing is happening, which we really applaud and thank everyone for contributing. And then tomorrow at Ocean Days, we will continue to leverage that to bring the finance discussion into oceans like today. So thank you also for co-hosting that event with us today, Rare. Across our strategy, we work on 3 different levels. So in terms of creating an ocean finance architecture, you need pipelines. So first of all, we really wanted to try to build pipeline and leverage all the great ideas which are currently leveraged by communities. And so we have started with several calls for proposals. Some of you are implementing partners here as well. And we're able to now, over the course of the last years, help partners on the ground to implement more than 40 projects on financial innovative solution. And I'm sure, Sarah, you will also talk about some of them. It's insurance products like Parametric Insurance, but also other innovative financial mechanisms in terms of trying to figure out how blue carbon on the local level can be implemented, as well as savings clubs and creating financial literacy, which I know ORRAA is also contributing to. So that is important for us to really build sort of that ocean architecture from the ground up. Ground up. Then secondly, it's about the enabling conditions, and that's also why we're here. I mean, this is a discussion on the global level, but policy needs to then really be implemented on the local and national level as well. So some of our projects are addressing that level as well, and then we also really encouraging our partners to build these enabling conditions on the national level and help on the global level to see how a holistic approach needs to happen. It is also then important to drive finance into the missing middle. So that is really the way where we feel a lot of attention needs to happen now. So some of the projects we are implementing are ready to scale, and the private sector engagement wants to invest, but it's that gap there. How do we sort of help these projects to scale? And that's where we are trying to figure out financial mechanisms like an ocean impact fund called the ORRRA fund, who will focus on smaller ticket-sized impact investing between 2 to 10 million, especially in the global south and the SIDS, to help these projects to be scaled. And then when we are able to do that, then we really talk about the top-down approach. So how do we, and that comes to your last question, think about these larger scale financial mechanisms and the financial architecture we need to sustain these projects over a longer run. And so over the course of the COP, you have heard a lot about blue bonds. And that is one mechanism. But under the Sea Change Impact Financing Facility, we as ORRAA, together with our partners, are trying to build an innovative financial architecture globally, where we are now incubating several ideas around this space, which are nascent in the ocean space, but valuable to bring lessons learned from the climate and green space into the ocean financing space. Before I answer the second part of your questions around the blue bond, so over the course of the last years, we have done landscape assessment, what is really needed, have talked with our partners how this global financial architecture could look like, and really what is missing. And so the impact bond I already mentioned is one of the cornerstones there, but it's also creating this blue market space. So we are building with partners what we call an octopus desk, where we really like to leverage building sort of ground up partnerships with our project implementers and project developers to then make the matchmaking with the financial institutions we need. So that is a crucial anchor also of that financial architecture needed when you then turn into blue bonds and other larger scale mechanisms to have that pipeline, which I mentioned in the beginning. Secondly, de-risking funding or the bringing de-risking the private sector funds into the global architecture is important. So we are building together with partners who have done similarly in the green space an ocean guarantee facility, which then helps to, as I mentioned, de-risking some of the investments. In terms of the blue bonds, and I think in the second panel we hear a little bit more about the role overall of the bond ORRAA is building, but what we are trying to do is really learning from the climate space and the green space, as I mentioned. And some of the lessons learned can be transferred, but we also feel that in the ocean space there are some of the challenges we need to address. So we are currently actually looking at creating a blue bond incubator to address some of these challenges. And this would be around how do we deal with the smaller sized and individual projects? How do we aggregate them? It's about how do we really define the increased benefits when we think about impact investment and valuing the social and economic impacts. But then also how do we structure it in a way that we can address some of the challenges in the aggregation. And so the Blue Bond Incubator will be something we are currently looking into and learning from debts for neighbor swaps, but also sustainable impact bonds, and hope that with that, we can help to contribute to building the market for blue bonds. And yeah, thank you.
Great. Thank you, Ariana. We are also excited by the work that ORRAA is doing and just delighted to be able to support as their programs grow and to think about the SCIF collectively together. For my next question, I'm going to be turning to Sarah. Sarah is someone that I've actually had the privilege and the honor of seeing her work in real time. We've worked together to develop a new parametric insurance that will be able to provide loss of income protection for small-scale fishers. Be on the lookout because we'll be piloting this next year. But that is certainly not all that Sarah does. Sarah has, in WTW, her team has put together so many interesting parametric products, whether they are to de-risk blue bonds, to be able to drive capital into the market, or whether they are to protect our coastal communities. And so I would like to turn this question to Sarah and to ask just a little bit more. Can you tell us about some of these innovative products that you're developing and share with us how they are protecting coastal communities and climate action?
Yeah, sure, Kate, and thanks so much for having me today at this event and panel. It's actually particularly notable because when I pivoted my career from traditional finance to the world of conservation and climate finance, I actually lived and worked in Indonesia for 5 years, starting around the time that Bali hosted the COP back in 2007. So sort of, it's funny how the world comes around full circle. But yeah, to your question, so indeed, WTW, we've really, been developing a number of parametric insurance concepts that are either targeting, protection of ecosystems themselves, livelihoods that depend on those same ecosystems and their services, and even, as you mentioned, some de-risking of blue bonds. Before I provide a few examples, though, just for those in the audience who are sort of new to parametric insurance and thinking, what are we talking about? Just quickly, parametric insurance is a risk financing instrument that pays out a pre-agreed amount to a policyholder according to pre-defined event characteristics, such as wind speed or rainfall. These pre-defined event characteristics are selected and serve as a proxy for impact or damage or loss. So unlike indemnity insurance, where you have to have a quantifiable damage and there might be a loss adjustment process, it could take months, it could take years. Parametric insurance has really opened up the possibility of insurance cover in contexts where it just hasn't been possible on the indemnity side. And unlike indemnity, parametric, because you've predefined and everything is set up at the outset, the payout tends to flow within weeks of an event without lots of back and forth and loss adjustment processes. Second, when we think about parametric insurance in the context of ecosystems, livelihoods linked to ecosystems, blue bonds, we sort of tend to see two clear sweet spots. One is where having money quickly after a shock event has high value. So for example, to offset income losses or to deploy for immediate restoration interventions that the ecosystem might benefit from following a damaging event. The second sort of example that we see as a sweet spot is where the value is guaranteeing that important payments will be made after a shock event reduces or eliminates the revenue stream that normally supports those payments. So, for example, in this case, to ensure that sovereign debt servicing obligations are met after a climate event that has a 15 or 20% impact on an economy's GDP and therefore potentially inhibits their ability to continue to service their debt. So with that sort of framing in mind, just to provide you with a few examples. So on the ecosystem side, we've developed and helped to place in markets several products that are supporting coral reef ecosystems. This includes programs such as the MAR insurance program, led by the MAR Fund, which helps to protect the Mesoamerican reef, spanning about 1,000 kilometers of reef, stretching from Mexico, Belize, Guatemala, and Honduras. 11 sites. There's also one that we've supported with the Nature Conservancy that is protecting the coral reef ecosystem around the state of Hawaii. In these cases, the sort of trigger is linked to wind speed, sort of the hurricane or cyclone or tropical storm wind speed. And if triggered, the payout is deployed to support immediate reef restoration, pre-agreed reef restoration interventions. But we also know that reefs are under threat from a number of different stressors. Yes, hurricanes, cyclones are of course one, but we're also starting to look beyond sort of these extreme events in supporting efforts to reduce some of the sort of longer term stressors. So for example, in Australia, we've worked with the Great Barrier Reef Foundation in Queensland to provide an insurance product for sugarcane farmers that allows them to reduce their use of fertilizer without concerns for the impact that that might have on their yield and ultimately their income, thus ultimately reducing the runoff of said fertilizer into the Great Barrier Reef. On the livelihood side, I would like to speak a little bit more, Kate, to the example that you highlighted, which, as you mentioned, has been a really amazing one, and with great thanks, of course, to support from our ORRAA and the Government of Canada, who is channeling the resources via ORRAA. In this case, so the parametric solution, as Kate mentioned, is helping fishers adapt to climate change by providing protection from income lost incurred because of bad weather, which prevents them from conducting fishing in a safe manner. So what does that mean? Well, so based on experiences of small-scale fishers, the ones that RARE has been working with for a long time, the product considers the actual weather conditions that impact their ability to go out and fish, namely wind speed, wave height, and rainfall. And the maximum payout is calibrated or reflective of the fisher's average monthly income. These parameters are captured into a single index that triggers by the badness of the weather over a 5-day period relative to what would have been expected under sort of normal experience or previous conditions. As Kate mentioned, we're in the process of finalizing the product. In the first instance, we're hoping that it'll be piloted with 50,000 fishers. The Department of Agriculture, Bureau of Fisheries and Aquaculture, DA-BFAR will serve as the policyholder, and the registered small-scale fishers who have also committed to certain sustainable fishing practices will ultimately be the beneficiaries if a triggering event occurs. So it's a really interesting application of insurance, and sort of insurance, I guess, as an incentive is one way to think about it. And we're hopeful that this same type of product is replicable in other contexts, of course, within the Philippines in the first instance, but potentially to some other geographies as well. Just briefly on the sovereign debt side, so recognizing as I think we've all been hearing in various events over the course of the COP, there's a very strong correlation between fiscal risk as well as climate risk. And also there's been some, I guess, initial solutions that have been introduced, namely something called the Hurricane Pause Clause, which provides temporary sort of relief, but ultimately shifts the payment schedule into a more climate uncertain future. So we at WTW wanted to develop a risk transfer product that actually provides insurance protection that steps in to cover those debt servicing needs after severe hurricane events. So specifically working with Slav, who unfortunately isn't with us today, but with Slav and others at the Nature Conservancy, as well as with the government of Belize and other partners that were involved in the debt conversion efforts back in 2021, we developed the world's first resilience wrapper, which is ultimately a parametric insurance solution that uses the objective criteria of hurricane characteristics to act as a proxy for the scale of the impact on the economy of Belize, and therefore the ability of the government to reasonably continue to make its debt payments without severely hampering their ability to provide the necessary disaster response and recovery support after an event. In this case, we actually have 3 different triggers which operate independently. There's a single sort of event, wind only. There's also multiple hurricane events in the same season. And finally, there's sort of a lesser intense hurricane, but one that's accompanied by heavy rainfall. If triggered, the government of Belize is waived of making that next semi-annual debt servicing payment, and instead, the insurance comes in and covers it instead. Of course, similar to some of the other examples I provided, this type of solution, depending upon which country and which circumstances you're thinking about, you could structure the trigger to be linked to other climate hazards like drought or flood, It doesn't have to be hurricane or wind speed related. Also, it's worth noting that this type of parametric insurance application is not only relevant in the sovereign debt space, but also in the private or corporate debt space as well for those entities that have some degree of exposure to climate-related risk. We're actually going to develop, and you may or may not have heard, because there's a lot of announcements coming out, but with thanks to support from USAID's EDGE Fund, and in collaboration with USAID and the Development Finance Corporation, DFC, WTW will be developing a resilience wrapper pilot facility for DFC's lending to private entities making adaptation investments in climate vulnerable countries and communities. So we're pretty excited about that. Of course, these are just a few examples of the multiplicity of situations in which parametric insurance might be beneficial to consider. Of course, it's worth flagging, and not to end on a sort of negative note, but parametric insurance is not a silver bullet solution, and it should always be considered in the context of a broader set of conservation and climate finance, options and modalities. Thanks.
Thank you. Thank you, Sarah. And honestly, one of the things that just delights me on this panel is I'm sitting next to somebody who has made insurance exciting and sexy, which is not something that I think most people think of. But the innovative way that we are using insurance right now to really crowd in capital to this space and to build resilience in coastal communities is something that should all be in our mindset. And it can't be the only solution, but it is part of the solution. And so I'm delighted that you shared that with us. I have had the great fortune in my life to work with many amazing women in structured finance and insurance. And so I know a lot of people in this room, but one of the individuals I'm just getting to know is Leah Glass. And what I have observed this week is that I am late to the party because she is a rock star at COP. Every panel that I go to on Blue Caravan, she is on. Every time somebody has a question, they are seeking her out. And so I feel so fortunate that very recently, through USAID funding, we were able to bring in Leah's brilliant mind to help us look at a pre-feasibility study in Mozambique. But that is just a very, very small sliver of the many, many things that Leah is working on. So I would like to turn to you and just ask if you could share with us a little bit more about some of the market standards in the voluntary carbon markets and the methodologies that you've helped to develop, both for Vera and for Plan Vito. And if you could tell us some of the trends that you're seeing as we try to scale nature-based solutions like blue carbon.
Thank you so much, Kate, and thanks for the very kind introduction. I hope that my few minutes will fulfill it. And also thank you for really facilitating this really interesting discussion about an important subject. So for the last 10 years, I've been honored to live and work in Madagascar, and it's kind of working with small-scale fishers and grassroots organizations to think about climate finance and blue carbon and what this means in kind of OECMs and how it can support resilience and adaptation, as well as mitigation along our coastlines. It's been a really interesting journey, and really over the last kind of 2 or 3 years, it's exciting because globally we're finally recognizing the importance of our oceans in the context of climate breakdown and how it is a solution, and the importance of incorporating it into management systems, policy, and everything like that. And I think it's a really important time for this conversation. It's a short summary. But the voluntary carbon market, which is where I'm kind of like my experience lies, as anyone that reads a newspaper will know, has really come under quite a lot of criticism over the last 6 or 12 months for good reason. And I think one of the hot topics at the moment really in buzzwords is integrity. What does integrity look like in the voluntary carbon market? And as we look to think about the VCM, what roles it plays in ocean governance and particularly OECMs, is thinking about what integrity looks like in that in this context. One of the things that is certainly recognized is from a kind of like the integrity from a carbon perspective is the need for third-party verified carbon credits. If you're looking to access climate finance, this importance of third-party verification. And one of the traditional ways of doing that is working with a standard, as you introduced, Kate. The good thing for coastal carbon is that there are already 2 standards that are applicable in the ocean environment that have methodologies that enable you to account and, well, monitor, report, and verify the climate impact of ocean governance. They're the VCS, managed by Vera, and Plan Vivo Climate, which is a smaller standard managed by the Plan Vivo Foundation in Scotland. And they already have methodologies that are applicable in blue carbon, and Vera also thinking beyond our coastlines to more kind of like seascapes and oceanic carbon, where the science is really, it's really only just starting to be built now, and we're trying to understand what's going on, but how can the voluntary carbon market contribute towards broader ocean management kind of away from our coastlines. Yeah, a lot of the work that I do is both Vera and Plan Vivo are updating their methodologies to kind of try and address some of the criticisms that have been going on recently and increase the integrity of how they, how projects monitor and report on their climate impact. And I think one of the things that personally I'm trying to do based on my experience and the kind of context that I see coastal communities work in is balancing rigor with practicality. The market, the investments, the investors, they're demanding rigor from the standards and from the projects themselves, and it's important that the methodologies provide pathways for projects to produce that integrity. But if climate finance is to flow to the people it really needs to flow to, which is kind of coastal communities and the people that are really doing the hard work along our coastlines and on the front line of climate change, climate finance from the voluntary carbon market really needs to flow to them. So how can we ensure these methodologies don't exclude projects which are led by coastal communities? And that's a lot of the thinking that I've been doing, is trying to demystify the science. And I think tech is an interesting component here. It's mentioned a lot. It's a buzzword. It's seen as a solution. Vera in particular is really looking at what they call DMRV, or digital monitoring, reporting and verification, as a way to I guess enable projects to reach a larger scale faster and cheaper, and it is exciting. It definitely has the potential to decrease the costs associated with carbon projects. But I think we need to think very carefully about how this tech is being developed. It's got the potential to empower communities to a certain extent, but it's also got the potential to disempower, because the voluntary carbon market, it's payments for performance, and that performance is assessed based on this MRV cycle. So it's really important that the communities, they understand what's happening in their ecosystems, they know what's going on, and it's really important that this local ecological knowledge is incorporated into these MRV systems, these tech systems, to ensure that we don't have these black boxes which nobody understands. And particularly the people that are depending on the payments from these mechanisms. Yeah, they're really thinking about that kind of transparency and that equity as we kind of like look to scale the voluntary carbon market. Yeah, I think that's. I just really resonate your last point that you made. Kind of really resonated with me in the fact that the silver bullet. There's a lot of attention on climate finance in the voluntary carbon market, and I certainly, even after 10 years of hard work, I may be a little bit tired, but I'm not jaded, and I really do think it is, an exciting, promising sector to help drive finance to the front lines of climate change. But it's not the silver bullet. It needs, and I think the breadth of this panel really, really helped to show that. So thanks again for bringing it together, Kate.
I'm realizing that we actually only have 4 minutes left, so although I had second questions for everybody before the next panel, I'm actually, Ariana, I'm going to put you on the spot because I think you sit in the center here, because in Ariana's position in ORRAA, who is our partner in so many things, they're looking at all types of different financing solutions, whether it's blue carbon, whether it's insurance, whether it's blue bonds, whether it's funds. And so one of the questions, Ariana, I would like you to share with this community is, as you were really starting to think about how we're going to drive more investments into nature-based solutions, what are some of the guardrails that need to be put in place to ensure that there are enabling conditions that allow these investments to be absorbed by local communities?
Yeah, thank you. I think let me start because we just talked about blue carbon, that at the last COP, together with some of our partners from TNC, CI, Salesforce, and the WEF, we put together, after really a longer period of consultations, the high quality blue carbon principles and guidelines, which I think is one a great example of how you, through collaboration, you can really make sure that when now a subject matter like blue carbon gets a lot of attention, and therefore also there's a lot of interest from the private sector to engage and finance, that you have these guardrails and safeguards in place. We spent the last year then also to work with communities to try to understand who would like to be the early adopters of such guidelines, what are the barriers, but also what are the opportunities here. And so you were actually also part of a solution lab we recently hosted, where across the different principles of the high quality blue carbon guidelines, we were identifying sort of pathways forward to help to accelerate the adoption of these guidelines, and now with the support also of the UK government can continue to actually help communities to adopt them by creating a practitioner's guide. So in terms of therefore also making sure that the funding is able not to only reach the ground, but actually really make sure that it's in a participatory approach. It also addresses equity, gender-related issues. You know, these guardrails are important. On the global level, and in terms of when we go back to the larger scale financial mechanisms, it's obviously important that all of these mechanisms have a common quality, let's say. So building upon the UNEP FI sustainable blue economy principles, it's important to make sure that all the different models are recognizing these KPIs and absolute standards, and that would be something also we are looking across all the different elements under the SCIF or the Sea Change Impact Financing Facility to embrace and then help the market to grow in the sense that others are embedding them as well.
Excellent, thank you. So with that, I would like to thank the panel today for this excellent conversation. And we are going to be moving on to our second panel. So I would like to welcome Chip to the stage as our moderator. And I will be moving to my left and to joining this panel. So thank you very much for staying with us.
Over. Thank you, Kate. Well, that was a great start to the second panel. So, in fact, let me ask my fellow panelists, so Oliver and Fegi, to also join me on stage. We're going to drive a little bit into a little bit more detail, actually, around the impact bond that Brett mentioned at the beginning of the piece here. And I'm very pleased to say that through ORRAA and funding from the Blue Planet Fund of the UK government and from DEFRA specifically, we have been very pleased to be part of and providing some finance towards it. So it's delighted to be able to do that. What we want to do really is to drive a little bit more into, as I said, in more detail around the impact bond, where it came from, the idea behind it, how it's going to impact, and then think about this from a replication and potentially scaling opportunity, as well as how it's going to impact in Indonesia itself. So, Kate, we know you. That's great. Thank you. Nice to see you again. Figi Nohabni, really delighted to see you here, and thank you for taking the time. You're Deputy Director of Disaster Mitigation and Climate Finance Adaptation at the Ministry of Marine Affairs and Fisheries in Indonesia. And I'm sure some of you may or may not know Oliver Withers from Standard Chartered Bank, Head of Biodiversity, and thank you very much for joining us. So, I'm going to start by jumping straight in, and a question for Kate, actually. Given the announcement today around the bond, I'd love you to just provide us a little bit more understanding of where the idea came from, how you started to think this through, how long it's taken, and indeed, what you see it being able to achieve for small-scale fishers on the ground.
Thank you, Chip. Please, thank you for bearing with me as I continue with this conversation, but now this is the part I'm most excited to talk about. So I really appreciate you asking the question of where this idea came from, because I want to spend a little bit of time talking about how our small-scale fisheries are chronically underfunded. Our small-scale fisheries tend to be managed by the subnational government and rely heavily on national budget allocations. It doesn't matter what geography we're looking at. This could be in Indonesia, this could be in Philippines, this could be in Mozambique, it could be in Brazil. They are run and managed at the local level, and there is not enough funding to support very important activities like enforcement and surveillance to make sure that our reserves are being protected and our fish are able to grow. And so when I joined RARE, Brett and his team had already been working on this very difficult challenge for over 10 years. And people were telling me, you know, private institutional investors are just not interested in oceans. And I started to look around the scene and realize that's actually not true. Institutional investors are demanding an opportunity to be able to invest in our oceans, but they can't because the capital cannot be absorbed. And the reason the capital can't be absorbed by small-scale fisheries is because small-scale fisheries tend to live in the informal economy. And what I mean by that is that they are not legally registered as an entity, which means that a nice bank like Standard Chartered can't legally provide money to them because they are not in a part of the formal economy. Our own research shows that 93% of micro businesses in the fisheries domestic value chains are not formalized. And let's think together with COVID what this really means. What this means, and I think this is the clearest picture, is all that stimulus funding that we saw national governments, that we saw multilateral organizations trying to put into this space in 2020 to make sure our micro businesses didn't collapse, never made it to the small-scale fisheries sector. It couldn't, because you can't give stimulus funding and you can't give any type of formal financial, services to an extra-legal entity. So we started to think at RARE, how can we address this problem? And our answer is a small-scale fisheries impact bond. Because in an impact bond, there is the ability for the investor to pay for outcomes. And I think the word impact bond confuses people. Like in a financial society, we think of, bonds that are being issued for $150 million. But impact bonds tend to be really below $10 million, and they are contracts between an investor and an outcome funder, in which, in this contractual obligation, the investor is reimbursed if the performance targets are hit, not missed. If they're missed, we have a big problem. And so in the structure that we're looking at right now, we have put together performance targets that will help us to legally establish 5 managed access and reserves, which is what Brett was talking about earlier. Really, the key word you should take from that is a reserve. So we're establishing 5 reserves, and the reason this is important is because we are all sitting at COP, probably still talking about 30 by 30, and our goal to protect 30% of the ocean by 2030. This is our answer to that for other effective conservation measures. But we are not just establishing reserves with this model, we are also putting into place fisheries management bodies that are legally registered so we can actually have them access capital and drive capital into that sector. And we are attaching business units to them so our local fisheries can start to actually invest in their own surveillance programs. And that will help to make sure that our fish stocks recover and that we are able to really make sure that our benthic coverage, which is coral reefs, who use crazy words, our coral reefs and our seagrasses are able to flourish. And this part of the model is what we're calling, the premium piece of it, the outcome-based. So at the end of 5 years of our model, what we expect to see is that within our reserves, the coral reefs and the seagrass will either be stabilized or recover, and our fisheries biomass will be stabilized and recovered. But to get there, we are putting in place the reserves, we're establishing our fisheries management bodies, and we are making them legal entities. The goal is to make sure that this is successful. And so to achieve this goal, what we've done is we've really looked at all the MARs that RARES have developed, and we've worked with external parties to include LAVOCA, which has put in place 10 of the only 206 impact bonds that were done to date to make sure our targets are accurate. The reason that this is important is we want to make certain that our investor is repaid, and that will allow us to scale. And so the way that we are launching this right now is we're launching it with philanthropy. We have an investor coming in. I'm not going to name the investor today. I'll say we're very close to being able to finalize this contract. And then we have outcome funders who are going to pay back this investor. Thanks to ORRAA and the support from DEFRA, our first outcome funder sign on, which will be paying back for the successful metrics that we hit. What we want to do in round 2 is move away from just philanthropy and have the outcomes paid for by governments. And so we've already had some conversations with governments in the geographies we work, to include the government of Indonesia and the government of Philippines, about what this could look like. And why we're so excited about this solution is it provides a way for governments to pay for outcomes and to invest in their fisheries after they see success, while simultaneously bringing the sector into the formal economy, so ultimately we will see it reflected in GDP. And so that's why we're excited. I hope you're excited too, but I feel that I've talked enough, and I will turn it back to you, Chip.
Well, look, I mean, it's great to be part of. It's fantastic that this has been, well, it's gone from an idea to inception, and we're very close to taking this into the economies itself. Vegi, I'm going to come to you next, if that's okay. And we heard from Director Youssef in his opening remarks around, the 30 by 45 initiative that Indonesia has, and the importance of marine conservation, of course, is really sort of central to the success of your priorities. But can you tell us, how can you use the bond, or how is the bond going to be used really to support your priorities within the ministry for small-scale fisheries, and indeed to maintain those healthy ecosystems?
Okay, thank you, Chip. Thank you for having me today. Referring to Director Yusuf's previous remarks, I think you can see that marine protected area is the first strategy, actually, from the 5 Blue Economic Strategy. Why? Because we believe by protecting our seas, our marine area, we can ensure that the fisheries resources will be sustainable and also can protect the environment. So this is the basis. The marine protected area is the basis. But we cannot go with 30 by 30, but we have set the target into 30 by 45, right? If you're going to have that kind of ambitious target, then we have the OECM, of course, with the customary communities. And what's interesting is that when it is a form of formal MPAs, like the one that are regulated by the government or the local government, like you said, it's very stable. It's very advanced. It can finance by a lot of mechanisms. You have a lot of bonds, or maybe another kind of blended finance to manage it. And we also have personals and offices and patrol and everything set up for the marine protected area. But for OECM, this is a traditional, right? It's a traditional community. It's very depends on their waters, and it's more informal, I think. Not too many people invest or finance them. So it's very great to hear some things like small-scale fishery impact bond exists maybe to, to give them some incentive, to give them support and give them like a reward as what they already did to their management area, because they're protecting the area as part of actually their culture, but their life also very depends on the area. If the area is broken or maybe they change the way they manage the area, the impact is huge. So I think we are allowed to discuss it more and deep dive into discussion with the small scale impact bonds. What is it? How to implement it in Indonesia? I think I'm looking forward for that. Back to you, Chip. Thank you.
It was great to hear from the government and the fact that you're obviously not only supporting but will benefit, or at least those thousands of people will benefit as well. Oliver, I'm going to come to you now, if that's okay. And as part of one of the large global banks that operates in emerging markets, I'm interested to hear from you around, and I know that you've obviously done a lot of work in this role already, but what are the challenges and opportunities that you see to be able to drive or utilize the instruments that we're hearing about today, not only for ocean conservation, but also to potentially bring in further investment into the space as well?
Thanks, Chip. So, I mean, starting with the challenges, I think language is really important, right? I think Kate alluded to this, and I'm going to kind of address an elephant in the room, and I'm sorry Slav wasn't here because I think he probably would have done it for me. Blue bonds are something very specific now, right? In September this year, ICMA came out. ICMA is the International Capital Markets Association, came out with a definition of blue bonds, right? Unfortunately, debt for nature swaps don't conform to that definition. Impact bonds don't conform to those criteria. I mean, to give you some context, the bond market is $133 trillion a year. Sustainable bonds are $900 billion a year. So going back to Brett's point, or context setting in the beginning, I think the numbers you outlined, 9 to 12 billion a year needed for MPAs, 175 billion needed for the overall ocean. I mean, actually, the capital markets are moving that kind of money. But I think we've also got to, Kate, you said institutional investors. The reality is, unfortunately, that we face is that a lot of those institutional funds that can deploy capital need those instruments to be ICMA aligned, right? So actually that cuts down a significant chunk of the institutional capital that's available. Another challenge is that institutional capital wants to write very large checks, right? If they're going to do the due diligence, which is an enormous amount of work because they're regulated, etc., they want to write large checks to make it worth their time. And so you need to work out how do we get that scale up quickly. Now, not ocean related, in a previous life, I stupidly tried to build a rhino bond, and this was a challenge we faced. And so another kind of issue that comes into this is because of the perceived risk on something new, the interest rate requirement goes up, right? And if you're putting somebody's principal at risk, the interest rate expectation gets high very, very quickly. And so what we did to try and solve that was shifted into actually the coupon is at risk, right? Not the principal. And that shifted dynamics for those institutional investors, and they were able to get comfortable. So I think that there are some challenges in terms of kind of how we access capital markets at scale, and we're not quite there yet. And I think that capital markets have got a little bit more work to do in terms of taking a step towards this environment, right? And we can't just hide behind ICMA. That said, for a financial institution, you will have all heard the term greenwashing, blue washing. We're terrified, right? Yeah. But financial institutions should not be defining what good looks like, right? So there was reference earlier to the blue carbon guidelines. That's hugely, hugely beneficial for us because we can point at that and say that's what good looks like, right? Not us defining it, this collective group defining it, and that's really, really powerful. I think we do need to keep in mind that there needs to be an ability to service the debt, right? And so, you know, when we talk about a strict blue bond, we're issuing it, the principles being deployed to theoretically generate returns to service that debt in some way, shape, or form. And I think, you know, we heard on the first panel the shortage of bankable opportunities, but that's why it's so important, the work that this community is doing around that missing middle, so that we can get more bankable opportunities at a certain level of scale, because then we can start moving money at scale. So I think there's definitely light at the end of the tunnel, but I do think that we need to be moving towards each other a lot closer. And I see Slav has joined us. How do we get the likes of ICMA to start becoming a little bit more comfortable with slightly more innovative stuff? Because the reality is that the problems we're trying to solve are not cookie cutter solutions, right?
Exactly.
And that is something that we've got to really crack. And I'll be honest, apart from dialogue and working together, I'm not sure there's any silver bullet solution.
I suppose the question is, you know, how far down the line are we to be making that happen? So yes, we're in this, you know, we come together and have these COPs obviously once a year, and we see each other probably, you know, a couple of times a year in other forums or fora. It's all great having these conversations, but actually we need to get action. And I think that, you know, what we're seeing here today is action. There's evidence, you know, here that we're actually sort of moving things forward, but it's a real sort of, I wouldn't say it's a struggle necessarily, but we just need to sort of move the dial. And again, this sort of comes down to collaboration and understanding and of course, expertise. Steph, I wonder whether you would pop up onto the stage. I'm afraid your name's not up here now, but it was. Don't worry. You can either sit next to me or you can sit next to Kate.
You know, I don't deserve to be on stage. I apologize for everyone for this scheduling and other logistical issues that I had today. We've all been there, and it's mea culpa.
Yeah, don't worry.
Sorry. So if I can contribute to this.
Well, look, I mean, we're very happy to go backwards as well.
No, we should definitely go forward. Assume I have read your mind because I know most of you on this panel. So let's just go forward.
Well, look, I mean, and I think that it is useful because I think that coming in at this stage, just thinking about, you know, the work that you've done with TNC within this, you know, this, I suppose, the blue bond space, it'd be great to hear a little bit more about sort of, you know, how you've utilised DFIs and how, you know, refinancing that debt has actually allowed investment to go into, you know, the coastal communities and biodiversity as well.
That's a great question, and it's a very timely question because just a couple of days ago, a group of leading DFIs, and if you haven't heard it, it's one of the good news out of this COP. Signed on to a task force and to a process. They committed to a process, a very definitive one that a bunch of industry participants will be nudging along to work together, right, to deploy these risk mitigation tools so that we can do transactions in the here and now. There's a lot out there in the policy arena that must happen for all of our problems to be solved, but in the here and now, with the imperfect tools of the trade that we have, we can do these large-scale transactions. And we and Pew have shown that in the last 2 years, right, we have raised over $2 billion for marine conservation, right, of which $800 million will be deployed into marine protected areas. And this is a significant achievement that should not be discounted and shouldn't be taken lightly. It's the beginning of the journey. And what needs to happen, right, for Oliver and others in the banking community to be able to crowd in private sector investors is for these transactions to be de-risked. Because we're talking about the most needful countries are the countries in the global south that have, you know, credit ratings of, let's say, B minus, et cetera. Many of them are facing yield to maturities exceeding 10%, right? The average African sovereign pays right now market rates of 15%. And so we need to radically reduce those interest rate expectations. And to do that is by plugging in, you know, a slug of public sector risk mitigation, political risk insurance guarantees, etc. And that has been the alchemy that has allowed us, in the case of Belize, which was in technical default, Gabon, which is triple C minus, Barbados slightly higher at B minus at the time, to be able for those deeply speculative grade sovereigns to have issuances that were AA2, right? And that then allowed institutional investors, the likes of Legal & General, the biggest pension fund insurance company out of the UK, to stream in where they wouldn't have gone before, because only basically hedge funds and vulture funds and high yield investors would touch these countries before, right? And so now a completely different asset class that has a much lower return expectations is coming in. And so what do? You basically, you know, refinance debt that is yielding double-digit territory with a new line that is, in today's interest rates, 4%. I'll do a very quick back of the envelope for you. Here is what we could do today, with nothing. We don't need to reinvent capitalism to do this. We get 4%, thank God US treasuries are a little lower. Call it 4.2% yield on the treasuries. Plus call it 1% or so DFI, you know, guarantee fee, plus call it 2% or so spread on that. So the math is 4.2, 5.2, 7.2. Let's round it down, right? Because we all need to be doing better. Let's round it down to 7. So we can do 7% money today, right, over a 15-year period for sovereigns that otherwise, if they went to market, would be paying well over 10%. So let's say that they're paying 11%, and we're giving them 7% money. The difference is how much? Let's see if anyone's paying attention. 4% or 400 basis points to be fancy. If you apply that on a, let's say on a $1 billion refinancing, what is that? It's $400 million. Let's divide that by 20 years. So that's $20 million year in and year out that would go into a marine protected area. You know, is that a meaningful amount? I think so.
Yeah, absolutely. So thank you. That's good.
You know, I compensate for coming late by speaking a lot, which is not necessarily a great thing.
It's not a problem. I think we've enjoyed it. Kate, I'm going to come back to you because, in fact, I'm going to come to the audience for a second because I'm interested to hear. I mean, I think it's great to have us, you know, ask you questions about this, and I'd like the audience to ask questions about all three of our panelists here, because I think that you know, understanding a little bit more about the bond itself, and if we haven't sort of nailed down what you need to know, please ask now. But it'd be great also to know anything you don't or haven't had answered necessarily from the point of view of Indonesia and those people who are actually likely to be impacted by it. And of course, we got Oliver here from the banking side too. So let's open the floor a second. Yes, sir. Can you just tell us who you are and where you come from?
System and so on. So how we would like to restructure this? Who will issue the bond? Is it a sovereign bond or non-sovereign bond, something like that? And also want to touch, like Oliver said, about the renewals bond, because we are working right now with the World Bank to launch what we call this a Coral bond. This is non-state, like maybe 15 million goes for million US dollar goes to the MPA, like I don't know, maybe in the investment like 200 or 300 million US dollar in the capital market. But this is like, you know, because World Bank is one of the, I don't know, principle to ensure the project. But for this one, how can we, looks like the structure of the bond, who will issue that? So.
Of course. Yes, happy to answer that question. And I think what we heard earlier is the word bond is thrown around lightly, but what Slav is working on, as we recently learned, is not actually considered a blue bond, and an impact bond is not a typical bond. So as I mentioned earlier, I think one of the things that we need to go back to is what is an impact bond? There have been only 210 of them that have actually been issued to date, and they're not issued as you would normally issue a bond. We're not taking it to the capital markets and de-risking it through political risk insurance to bring an investment rating of AA. What we are doing is we are having a contract, which was what an impact bond is a contract between the investor and the outcome funders. And so the investor can be an investor that comes from private capital, it can be institutional investors, it can be philanthropy. I will tell you that the investor that we have in this impact bond right now is coming from philanthropy. And so what happens is the investor puts their capital at risk up front, provides it to a service provider to reach the outcomes. The outcomes, as we talked about in this impact bond in Indonesia, are to be able to establish managed access with reserves, be able to legally establish fisheries management bodies, and be able to attach a business unit to it. Then the final outcomes that we're hoping to see is the return of biomass and the stabilization of biomass and the stabilization of benthic coverage. When those things happen, the investor is repaid by the outcome funder. The outcome funder, as Chip mentioned earlier, thanks to the good work of ORRAA, and this structure is DEFRA from the UK government and others who will be joining us in this structure. As we look to scale this, there could be a way where we eventually get to SLUV, where we are actually issuing something in the capital markets. But I would suspect that both this first impact bond and the second one that we're sizing around $50 million will be a contractual based obligation pay for performance model. Thank you.
Yes, sir.
Thanks to all the speakers. My name is Ben Thompson. I'm an assistant professor at Monash University in Australia, and I've written journal articles on impact investing in biodiversity conservation, blue bonds, impact bonds, even Oliver's Rhino bond. My question is actually for Kate. You mentioned obviously this impact bond and the success of it. I was wondering if you could just elaborate a little bit on what success looks like, what targets need to be hit, how were those targets devised, who did you consult with to devise those targets? Was it the fishers? Was it DEFRA? And how are you going to measure them? Thanks.
Absolutely. So the way the targets were devised was looking at RARE's Fish Forever program. As Brett said when he introduced and started our keynote address today, Fish Forever is a program that RARE has been running for 10 years. In this program, what we are doing in over 2,000 communities right now is establishing a community-led fisheries management system. We call it Managed Access and Reserves. I think the international community is moving towards the word OECM, which is Other Effective Conservation Measures. So what we did is we looked at our 10 years of data to understand what realistically we could achieve in this 5-year tenure that we have for this contract. And we wanted to make sure that our outcomes were meaningful and would come to the tangible, my words are failing me here, but biomass and benthic coverage outcomes that the community and the world wants to see. And so we have structured this that in the first 4 years of this 5-year impact bond, the principal will be repaid for our ability to legally establish reserves, for our ability to put together fisheries management bodies that have governance in place that includes the local community and their customs, and to have these fisheries management plans then approved by the subnational and national government. And the next trigger for repayment for the principal is our ability to put together a business unit that is attached to these fisheries management body that will allow our fisheries management bodies to start earning revenue outside of just budgetary allocations. And this will look like very small micro businesses, which include the sale of ice and the sale of gear. For us, it's very important that we start to provide a way for our fishers to purchase sustainable gear. So that will also support that transition. So all the principle of this contract is tied to those factors. Then we have premium payments, which premium is really just interest. And these interest payments, we have tied them to things that are a little bit harder for us to control because of climate change and because of the world around us. And so there's a possibility that the investor will earn up to 5% interest in this model, and that will be measured in year 3 by divers, and in year 5, when we're looking at whether or not the biomass and whether or not the benthic coverage has been stabilized or increased. We will look at year 3 and year 5, and if that has been achieved, then our investor will earn up to a 5% interest. This is our very simple proof of concept structure. As I said, we are planning to scale this, and you'll see additional outcomes in phase 2. But phase 1 is keeping it simple and getting it out there so we can scale this hopefully to $160 million by 2030.
Thank you, Kate. Thanks for the question. Figgy, I'm going to come back to you if that's okay. Just in terms of, I'm just thinking about back to the communities themselves and how the government and how your ministry is engaging with those communities around the bond. And I know, of course, you're doing a lot of work with ORRRA, but how are you engaging with them to showcase the importance of this bond as a way of driving further finance and indeed sustainable development in their communities or those communities?
Yeah, that's a difficult question. But yeah, when engaging with the community, I think the customary community is under their rights is acknowledged by us, right? So we have a lot of intervention for them with a lot of support for their not only finance but also a lot of things to support their livelihoods. So I think that's the way we can engage with them. You know, talking about the bonds, whether it's suitable and can be applied to them. I think the most important thing when we're talking about the small this bond is the form, how we define it, and whether it's suitable and, you know, with their way of life, you know, with their social economic condition, because I believe that there's no one solution for everything, right? So how we can define and adjust the bond to be applied into the customary community in Indonesia, because we have like 26 customary communities, and each has their own culture. So the one that in Papua will not be the same with the one in Maluku. So it's very, we need to talk with them, of course, and see the opportunities that we can, that result from the discussion with the community itself. I think that's
Thank you very much.
Yeah.
Or maybe final question to you. Oh, sorry, sir.
Oh,
1 minute. Oh,
Audience question. No,
oh,
audience
okay.
question.
I see 1 minute.
oh, 1 minute. Okay.
Not 1 minute.
Thanks very much for a great panel. Both of them are really interesting. My name's Nadine Grant. I'm with Plan International Canada, and we're a gender rights, child rights organization, but we also work with communities, mangrove protection and other areas. My question is just around the bond in terms of, we do have an impact bond, one of the 216 impact bonds. I'm curious why you didn't put gender as a multiplier for your investor. You said you have premium payments. I would have thought the gender, it seemed a bit gender blind, I'm not going to lie, the panels, the two panels. So I'm just wondering why, given that women are predominant, you know, in the small scale fisheries industry, and why that wasn't considered as one of your outcome payments to have a multiplier for women.
Gender is, thank you for that question. Gender is absolutely considered in the structure. What we have done is we've tied the outcome payments for principal to targets that we know will achieve the results for benthic coverage and for the stabilization of fisheries biomass. but behind the scenes as we work to scale this, and so we're hoping the second issuance will be in 2026, we are measuring the number of women-led businesses that we are able to formalize on the domestic value chain. So part of the innovation model of this impact bond, which I haven't gone into detail of today, is not just to formalize businesses for the fisheries management bodies, but we'll be developing a business development hub where we're working directly with our domestic value chain actors to bring their micro businesses into the formal economy. We've already actually started this pilot to measure the results in Indonesia, and we've formalized 75 micro businesses in the last year. And what we found is that over 45% of them are women-led. And so we've put together an apprenticeship program where we work with women to formalize their micro businesses and provide them with the capacity and the skills that they need to thrive in the formal economy. That is most definitely a part of this impact bond. It's my apologies for not bringing it into this conversation. The reason that I didn't is we have not tied outcome payments to women yet because we're measuring it in this model. So when we roll out Model 2, we have the right numbers and the right goals that we can achieve success, because it would be crippling to us to miss those targets, and we did not have enough data to put them as a target in Sector 1.
Thank you for the question. Thank you, Kate, for answering. So do you have 30 seconds on that?
30 seconds on that. Sometimes when you sort of on the macro scale of the conservation and coastal bonds, sometimes when you throw big numbers, that can imply that you're only working, let's say, with central governments, which is the case in terms of in the sovereign transactions in terms of closing the financing, but then the savings that I mentioned earlier flow into a conservation fund that we establish, and it is the conservation fund that receives requests for funding from local communities, and it is our conservation funds that very much have a gender lens as part of the durable, equitable, just protection of coastal areas. And just to make this super concrete, I was blessed to be in Belize about a month ago, where we saw some of the work that already has been undergoing for 2 years. There is an impact report that I encourage everyone to read if you can, but the best part was that we went and visited a women's owned startup seaweed cooperative, and that is kind of what makes this all worthwhile, these very abstract notions, to see them on the ground or actually in the water.
Thank you, Slav. I know we've got 2 minutes, 24 seconds to go. So, Oliver, I'm just going to, I'll come to you for a little sort of minute sort of overview. I just want to think about hopefully the success of this, but the replicability of what we've heard today. Because I think that, someone who is driving, these innovative mechanisms yourself, how do you see this being replicated into different parts of the world?
So, listen, I come back to the partnerships, right? We need more TNCs and slabs, right? We can, as a bank, we can get involved in the financing, the structuring, but again, we need partners that are going to focus on the thematic that we're focused on, right? So, in the Debt for Nature swap case, the fact that TNC are there from start to finish, as a bank, we execute, we exit, but we know that TNC are still involved. That's really, really important. We need to know that the implementation is going to be delivered, right? So we have to close the gap on the partnerships. I think in terms of replication, Slav didn't mention it, but if you think about Seychelles Blue Bond, right, that followed a debt swap. That was $15 million. To Slav's numbers, we're now $2 billion and $400 million going into conservation. So this stuff scales quickly, but it's partnerships that drive it.
Great. Well, I think that's a great sort of segue into, I suppose, closing remarks, because I think that certainly from our perspective at ORRAA, and I know Ariana provided a little bit of an indication that we are a membership organisation with 82 members, and I'm pleased to see that actually there are quite a few members in the room and indeed on this panel. But it is around collaboration that is actually going to make this work and make this happen. We saw Brett's slide around, and I know that Oliver has also indicated and showcase that $175 billion that's required to be driven into this space. We are touching the waters at the moment in terms of those numbers, but I think, you know, if we are to increase those finance commitments, we need to not only identify those pipeline of projects, but also to drive and develop that overall architecture into around this space to allow this kind of finance to be invested. Slav, I know that you talked a little about de-risking DFI's insurance, not only from both from the government side, but also the private sector. You know, concessional finance, guarantees is hugely important in terms of all of that, and I know you've discussed that as well. Those standards and guardrails, you know, ultimately we don't want this to be a Wild West. We need to be working with our partners to ensure the integrity, indeed, of these kind of mechanisms, which of course help to drive finance in a longer term that are going to impact positively for those people who are most at risk in small and developing states and least developed countries. And I think, you know, the impact bond that we've heard about today, and Kate, thank you for providing a little bit more detail at the end here around what it can do. We're very proud to be partnering with you. It's great that the UK government has stepped up into this position. Pleased that they, you know, they are, I know, proud as well. And we're very appreciative of ORRAA's partnership and indeed all of those partners in the room today. But I'd like to thank you all for coming today and enjoy the rest of your COP. Thank you.